Most people think financial collapse looks dramatic. It usually doesn't. It looks normal right up until the rules change, purchasing power disappears, and millions realize they were never poor on paper, only poor in reality. There's a recurring pattern in financial history. It doesn't begin with panic. It begins with confidence, stable currency, trusted institutions, predictable systems. Then something shifts. Quietly, governments change incentives, banks change rules. Access to money becomes conditional, and by the time the public reacts, the exit doors are already crowded. In this video, we're going to break down one core mechanism behind financial unpreparedness: how systems train populations to rely on stability and then remove it. We'll look at how this has played out before, who saw it early, who didn't, and what actually held value when confidence broke. This is not financial advice. This is historical pattern recognition, because the goal isn't prediction. It's understanding how people get trapped and why it keeps happening. If this feels familiar, it should. These patterns aren't rare. They repeat across countries, across decades. The details change, the mechanism doesn't. If you're here, you're not looking for noise. You're looking for signals. So subscribe if you want to track these patterns as they unfold, not after the headlines, but before the rules change. Because by the time it's obvious, it's usually too late. These patterns aren't rare. They repeat across countries, across decades. The details change, the mechanism doesn't. If you're here, you're not looking for noise. You're looking for signals. So subscribe if you want to track these patterns as they unfold, not after the headlines, but before the rules change. Because by the time it's obvious, it's usually too late to reposition. Would you like me to revise this section, or should I continue to the next one? Okay. Section 5. Winners and losers. When financial systems begin to fracture, losses don't happen evenly, they cascade, and they follow a pattern. The first group to lose is almost always the most confident, people fully integrated into the system. Salaried workers, retirees on fixed income, middle-class savers holding cash in banks. On paper, they look stable, they have savings, they have accounts, they have access, but that stability is conditional. It depends on three things staying intact: currency value, bank solvency, unrestricted access. When any one of those breaks, the illusion cracks. Cash in the bank begins to lose purchasing power first, slowly at first, then faster. Inflation doesn't feel like a crash. It feels like pressure. Groceries rise, rent rises, energy rises, but wages lag behind. So the loss is quiet. No headline, no alarm, just a steady decline in what money can actually do. Then come the restrictions, withdrawal limits, transfer delays, foreign currency controls. At this stage, something important happens. Money still exists, but control over it changes. This is where the second group begins to lose. Business owners dependent on liquidity, importers, manufacturers, anyone needing reliable access to capital. They may have strong balance sheets, but if they can't move money, they can't operate. Supply chains break. Inventory stalls. Revenue collapses. Not because demand disappeared, but because access did. Now we move to the third layer, asset holders. This group often believes they're protected. They own real estate, stocks, retirement accounts, and in nominal terms, they might be right. At first, asset prices often rise during monetary expansion, but there's a distinction that becomes critical: nominal value versus real value. An asset can go up in price while losing purchasing power. We've seen this repeatedly. In inflationary environments, stocks rise, but when adjusted for currency devaluation, the gains shrink, sometimes disappear entirely. Real estate follows a similar pattern. Prices surge, but so do costs. Taxes increase, maintenance costs rise, liquidity dries up, and in some cases, governments intervene directly. Rent controls, property taxes, transaction restrictions. So while the asset exists, its usefulness changes. Now, the question becomes, who actually preserves value? History gives a consistent answer: those with direct control over assets. Not claims, not promises, control. This includes people holding hard assets outside the financial system: precious metals, certain commodities, tangible goods with intrinsic demand. These don't depend on institutional permission. They don't require a bank to access. They don't rely on digital systems staying open. But even here, there's nuance. Not all hard assets perform equally. Liquidity matters. Portability matters. Recognition matters. Gold, for example, has historically preserved purchasing power across monetary resets, not perfectly, not instantly, but consistently over long periods of currency instability. Another group that tends to navigate these periods better? Those with diversified access, multiple banking relationships, exposure to different currencies, geographic flexibility. Not because they predicted collapse, but because they reduced single points of failure. Then there's a less obvious group, people with adaptable income streams, skills that translate across environments, trades, services, portable expertise. When systems tighten, income tied to rigid structures suffers. Income tied to flexibility adapts. Micro summary. In financial disruptions, what you own matters less than how you own it. And what you can access matters more than what you're promised. The biggest losses don't come from market crashes alone. They come from the moment people realize their wealth was never fully under their control. Now bring this forward, not as prediction, as pattern recognition. The United States is not Argentina. It's not Lebanon. It's not Greece. But the mechanism doesn't require identical conditions. It requires similar incentives. Start with U.S. government debt is structurally high. Corporate leverage is elevated. Household debt, credit cards, auto loans, mortgages, remains deeply embedded in daily life. This creates the same constraint we've seen before. The system cannot tolerate sustained tightening because higher rates don't just slow growth, they stress the entire debt structure. So policy tends to lean in one direction: support, liquidity, intervention, stabilization. We've already seen versions of this, moments where markets didn't self-correct. They were backstopped. Again, not unusual, but it builds a dependency loop. Markets begin to expect intervention. Institutions rely on it. Valuations adjust around it. And over time, something subtle happens. Risk is no longer removed. It's redistributed. Now look at where most Americans sit inside this system. Retirement accounts tied to markets, savings held in banks, income tied to employers dependent on credit conditions. Everything works as long as access remains open and confidence remains intact. But zoom in on the pressure points. Banking consolidation. Fewer institutions controlling larger pools of deposits. This increases efficiency, but also concentration risk. Digitalization of money. Convenient, fast, frictionless, but also easier to monitor, restrict, or gate if conditions change. And then there's inflation. Not extreme, not hyperinflation, but persistent enough to erode purchasing power over time. This is where the modern version of the mechanism becomes harder to see because it doesn't look like collapse. It looks like drift. Prices rise faster than income. Assets inflate beyond fundamentals. Cost of living tightens quietly, and most people adapt instead of reacting. They adjust budgets, take on more debt, stay invested, because there are few alternatives, which reinforces the system further. Now, to be precise, there are still strong institutional advantages in the U.S. Deep capital markets, reserve currency status, global demand for dollar-denominated assets. These are real buffers, but they don't eliminate the mechanism. They delay and reshape it. The key parallel is not outcome, it's structure. High dependency on financial systems, high reliance on institutional access, high exposure to policy decisions, which leads to a familiar vulnerability. If the rules shift, even slightly, the impact travels quickly, not necessarily through collapse, but through restriction, repricing, and reduced optionality. Micro summary. The modern risk isn't sudden failure, it's gradual constraint. A system that continues to function, but with less flexibility, less access, and less real purchasing power over time. And most people won't recognize it because nothing breaks all at once. So what actually works when the system tightens? Not predictions, not timing the exact moment. Historically, survival comes down to structure. First principle, reduce single points of failure. If all your liquidity sits in one institution, you're exposed to that institution's rules. Diversification isn't just about assets, it's about access. Multiple accounts, different custodians, different forms of liquidity, not for yield, for optionality. Second principle, differentiate between price and purchasing power. An asset going up doesn't mean you're getting ahead. The question is simple. Can it maintain real-world utility through currency pressure? That lens filters out illusions quickly. Third, prioritize control over convenience. Systems optimize for ease, fast payments, centralized platforms, seamless integration. But every layer of convenience adds a layer of dependency. Historical survivors tend to hold at least part of their wealth outside systems that can be paused, restricted, or repriced overnight. Not extreme, just intentional. Fourth, build during systemic stress. Static income suffers. Flexible income adapts. Skills that translate. Services that remain in demand. Work that isn't fully dependent on one channel or one institution. This isn't about abandoning structure. It's about not being fully locked into one. Final principle. Assume rules can change. Not dramatically, not all at once, but gradually enough that most people won't react in time. Preparation, in historical terms, isn't panic. It's margin. Room to move when others can't. Micro summary. Financial resilience isn't about predicting collapse. It's about staying functional if the system becomes less flexible than it used to be. Most financial systems don't collapse in a single moment. They adjust, quietly, incrementally, until the version people trusted no longer exists. And by then, most are still playing by the old rules. That's the pattern. Not chaos first, constraint first. Access narrows, options shrink. Purchasing power fades in ways that don't trigger immediate alarm, and the majority adapts, instead of stepping outside the structure that's changing beneath them. This is why unpreparedness isn't about intelligence. It's about positioning, where you sit when the rules shift, what you control when access tightens, what you can still do when others are forced to wait. The warning isn't that collapse is guaranteed, it's that the mechanism is familiar, and it is played out enough times to be studied, not ignored. If you're still here, you're not looking for comfort. You're looking for clarity. Subscribe if you want to keep tracking these patterns, not as headlines, but as systems in motion. Because the people who recognize the structure early tend to have options later.